So picture this. You wake up, check the news, and find out that billions of dollars have just vanished from the market, literally overnight. Well, on March 19th, 2026, that's exactly what happened. A massive financial shockwave ripped across the entire globe. We're going to follow that trail of chaos to figure out what on earth caused it, and maybe more importantly, what it tells us about just how connected our financial world really is. Okay, let's put a number on the damage, right? 7 lakh crore rupees gone. That's how much investor wealth just evaporated from the Indian market in a single day. A number that big, it doesn't just raise your eyebrows, it screams the question, how in the world did this happen so incredibly fast? And what's really wild about this is just how uniform the panic was. Look at this. India's two main benchmarks, the Nifty 50 and the BSE Sensex, they fell in perfect lockstep, both down the exact same amount, 3.26%. This wasn't just a bad day at the office. This was a total, across-the-board collapse of confidence. So to really understand the global story, we have to start at ground zero, right? And that's the Indian market. Let's dig in and see how what started as a normal trading day just completely spiraled out of control. So the big question is, what could possibly cause a financial earthquake like this? What was the trigger? Yeah, see, this wasn't just one thing. It was more like a rapid-fire succession of punches to the market. So let's break down the 3 immediate triggers that basically combined to create this perfect storm. Okay, so here's how it all went down. It was like a 1-2-3 punch. First, you get a huge leadership crisis at India's biggest private bank. Then, boom, a massive spike in global oil prices. And to top it all off, a really disappointing announcement from the US Central Bank. Now, any one of these on its own is bad news, but all 3 hitting at the same time, well, that's pretty much the recipe for a market crash. It all kicked off with a massive shockwave from HDFC Bank, a real titan in Indian finance. The chairman suddenly resigns, and the reason given is these vague concerns about values and ethics. Now, that is exactly the kind of language that sends investors running for the hills. The reaction was instant. Its US-listed shares tanked by around 7%, and the Indian stock followed, dropping over 4%. And here's the thing. When a bank that massive stumbles, it doesn't fall by itself. It dragged the entire financial sector right down with it. And then, as if that wasn't enough, came trigger number 2, oil. Now, you've got to understand India's economy is incredibly vulnerable to oil prices because it imports something like 85% of its crude. So when prices shoot past $110 a barrel, it's not just some headline you skim past. It's a direct threat to the whole economy. We're talking higher costs for fuel, for transport, for manufacturing, basically for everything. And there's actually a name for this whole phenomenon. It's called imported inflation. It's pretty simple, really. When the cost of stuff you have to import, like oil, goes up, well, that price hike eventually gets passed on to everyone back home. It just makes everything more expensive. But hold on. Here's where the story gets a whole lot bigger. You have to ask, right? Was the HDFC crisis and the oil price spike just bad luck? 2 totally separate events? Or were they just the tremors on the surface from a much, much bigger global earthquake that was already happening? So let's zoom out for a second, because the real story here isn't just playing out in Mumbai. It's being driven by decisions in Washington, D.C., and conflict in the Middle East. And we're about to see how this global domino effect works in real time. This right here, this is the heart of the problem. It shows the massive gap between hope and reality. On one side, you have what the markets were dreaming of, the US Fed cutting interest rates multiple times, which would just pump fuel into the economy. And on the other side, the cold, hard reality. Maybe one cut, if they're lucky, late in the year. That wasn't just a disappointment, it was a total gut punch to investors. And for a market like India, when US rates stay high, it often means global investors pull their money out and look for safer bets. That was the fear that just sent a shockwave through the market. So why the hesitation from the Fed? Why not give the markets what they wanted? Well, it all comes back to this. You had rising tensions in the Middle East, pushing those oil prices through the roof. And that meant global inflation was staying sticky, just stubbornly refusing to come down. The Fed's hands were tied. They just couldn't risk cutting rates when inflation was still such a big threat. And make no mistake, India wasn't alone in this, not by a long shot. Let's take a quick look across the region, because these shockwaves were hitting pretty much all of Asia. Just look at the numbers here. Sure, India took the biggest hit, down over 3%, but Japan's Nikkei wasn't far behind at all, and Hong Kong's Hang Seng also got hammered. This proves it, right? This wasn't just an Indian problem. This was a full-blown regional crisis, and everyone was reacting to the same global fears. So, okay, after a day as brutal as that one, the big question on everyone's mind is, what happens now? What's next? Let's look at the key things everyone's watching to figure out where we go from here. All right, this table pretty much sums up the new reality. First up, the Fed. Don't expect any help from them anytime soon. Crude oil, that is still the biggest risk for India, for sure. HDFC Bank, yeah, the whole market is now watching to see if it can recover from that governance mess. Foreign investors, they're probably going to keep selling until the oil situation gets a lot more stable. And that last thing, the India VIX, you can think of it as the market's fear gauge. And yeah, it's going to be running high, which just means expect more bumpy days ahead. So what's the bottom line here? It's that we are firmly in what they call a risk-off zone. All that means is investors are spooked, they're fleeing to safety, they're selling off stocks, anything that feels risky. And since this whole thing is being driven by these huge external shocks, well, this volatility is probably not going away anytime soon. And that leaves us with one last kind of scary question, doesn't it? In a world this connected, where a conflict halfway around the globe and a policy decision in another country can wipe out fortunes literally overnight, was a day like March 19th a shocking one-off event? Or is this extreme, high-speed volatility